We were promised that Bitcoin was a digital gold. We were told that it was the ultimate hedge against geopolitical chaos and government money printing. But when the US president announced a massive 15% global tariff, the market didn't behave as the maximalists promised. Gold shot up more than 2.6%. Bitcoin plummeted below $65,000, dragging the entire altcoin market down with it. In a matter of hours, over $500 million in leveraged positions were wiped off the map. The safe haven narrative just failed its biggest test on the global stage. Since the crypto market's peak in October 2025, a staggering $2.22 trillion has been completely erased. Institutions are pulling billions out of Bitcoin ETFs, miners are dumping their entire treasuries, and the fear and greed index has collapsed to levels we haven't seen since the March 2020 COVID crash. So, is the digital gold thesis officially dead? Are we looking at a cascading liquidation event that sends crypto back to the Stone Age? Or is this actually the ultimate contrarian setup for a massive wealth transfer? And that is exactly what we are going to cover today. My name is Nick, and you're watching The Coin Bureau. First things first, let's look at the catalyst that just sent a shockwave through the entire global economy. To understand why Bitcoin is crashing, you have to understand the legal drama that unfolded over the weekend. On Friday, the 20th of February, the US Supreme Court handed down a momentous 6-3 decision in a case called Learning Resources Inc. versus Trump. The court ruled that the president's previous sweeping tariffs imposed under the International Emergency Economic Powers Act, or IEEPA, were unconstitutional. For a few brief hours, the markets actually cheered. Bitcoin actually bounced from $66,500 toward $68,000. But the celebrations, they didn't last long. Within a few hours of the ruling, the president fired back on Truth Social, invoking a completely different, never-before-used law. He announced a new 15% global tariff under Section 122 of the Trade Act of 1974. Now, in case you didn't know, Section 122 allows the president to impose temporary import surcharges of up to 15% to address, quote, fundamental international payments problems. It is a 150-day emergency measure that applies to virtually all nations simultaneously. It is historically unprecedented, and the market reaction was absolute carnage. Bitcoin shed more than 5% of its value in under 2 hours, falling from $67,600 to a low of $64,090. This sudden drop triggered a cascade of forced selling. According to CoinGlass, total liquidations hit $505 million in just 24 hours. Over 136,000 traders were liquidated, completely evaporating open interest across crypto derivatives from a peak of $38.3 billion down to just $19.5 billion. But the headline that grabbed everyone's attention wasn't the dollar amount of the liquidations. It was the devastating divergence between Bitcoin and traditional safe havens. For years, the core thesis of the industry has been that Bitcoin acts as a non-sovereign store of value. When traditional markets panic, Bitcoin is supposed to be the life raft. But on tariff day, that life raft sank. While Bitcoin was dropping 5%, physical gold surged 2.64%, crossing over $5,200, bringing it back near its all-time highs. That is a 6.27-point divergence on the exact same macroeconomic shock. At its peak in December 2024, one Bitcoin could buy you about 38 ounces of gold. Today, that figure has fallen to roughly 13 ounces. Bitcoin has lost more than 62% of its value relative to gold in little over a year. And it's not just gold. When the tariff news hit, Bitcoin moved in near lockstep with the Nasdaq index. Its correlation with the tech stocks has swung from a negative 0.68 to a highly positive 0.72 in just a matter of weeks. I know this is hard to hear for the die-hard hodlers, but the data does not lie. Right now, Bitcoin is not trading like a digital gold. It's trading like a high-beta leveraged tech stock. When Wall Street panics over tariffs and supply chains, they don't buy Bitcoin to protect themselves, they dump it. And the smart money is already heading to the exits. Since late January, the US spot Bitcoin ETFs have logged 5 consecutive weeks of net outflows. Over $3.8 billion has been pulled from the ETF complex in just over a month. BlackRock's IBIT alone shed roughly $2.1 billion, while Fidelity's FBTC saw about $954 million walk out the door. Institutions do not like uncertainty, and a global trade war is the ultimate uncertainty. But it isn't just Wall Street suits who are heading for the exits. The miners are capitulating too. BitDeer, currently the largest publicly traded self-operating mining company by hash rate, just did the unthinkable. In their latest weekly update, they revealed that they sold 189.8 newly mined Bitcoin and liquidated their entire reserve of 943.1 Bitcoin. They now hold exactly 0 Bitcoin on their balance sheet. When the biggest miners in the world are dumping their entire treasuries, you know the pressure is real. And to make matters worse, the liquidity that usually buys these dips is evaporating. According to CryptoQuant, the 60-day market cap change for Tether, or USDT, has dropped below negative $3 billion. Stablecoins are the dry powder of the crypto market. When USDT contracts by billions of dollars, it means capital is leaving the ecosystem entirely. And speaking of staying ahead of these macroeconomic shocks before they wipe out your portfolio, you need to be where the news breaks first. The Coin Bureau Telegram channel is where we share the latest breaking news, provide deep dive alpha, and give you the most important market updates, all pinged directly to your device so you don't miss a thing. Whether it's a surprise Supreme Court ruling or a massive miner capitulating, our members knew about it first. So, sign up today using the link down below or by scanning this QR code over here. Okay, back to the macro picture, because to truly understand why Bitcoin is bleeding, we have to look at the impossible trap the Federal Reserve is currently caught in. Conventional economic wisdom will tell you that tariffs lead to inflation. When you slap a 15% tax on imported goods, companies don't absorb that cost, they pass it on to you, the consumer. And we're already seeing this in the data. The Core Personal Consumption Expenditures Index, or PCE, which is the Fed's preferred inflation measure, just came in at a hot 3% year over year. This completely shatters the narrative that inflation was cooling down to the Fed's 2% target. So the Federal Reserve is trapped. They want to cut interest rates to support a slowing economy, but they cannot cut rates if tariffs are causing inflation to spike again. If they cut rates into rising inflation, we get stagflation. And stagflation is the absolute worst case scenario for risk assets like tech stocks and Bitcoin. And this is why the 10-year Treasury yield is falling and the US dollar index, or the DXY, is holding strong near 97.8. Investors are fleeing to cash government bonds and to gold. They are de-risking. And because Bitcoin ETFs have integrated crypto into the traditional financial plumbing, Bitcoin gets sold right alongside everything else. When a hedge fund's algorithm tells it to reduce risk, it sells Apple, it sells Tesla, and it sells BlackRock's IBIT. It is institutional correlation by architecture, not by coincidence. So, is it time to pack it all up? Are we heading into a multi-year Bitcoin winter?
Want to be perfectly blunt?
No, and here's why. Everything I've just shown you, the tariff chaos, the fear, the institutional selling, it's all setting up for what could be one of the most historically significant buying windows in Bitcoin's history. Let's take a look at that fear and greed index. Right now, it's sitting at 5 out of 100. That is extreme fear. Do you know the last time sentiment was this bad? March 2020, the COVID-19 crash. And if you know your Bitcoin history, you know exactly what happened in the months after that reading. Historically, market bottoms tend to line up with the index dropping into extreme fear, forcing the final wave of capitulation. But it's not just sentiment, it's the maths. Since 2014, Bitcoin has experienced 9 major corrections where the price dropped between 40 to 50% from its cycle peak. We are currently down roughly 48% from October 2025's all-time highs of $126,000. Now, do you know how many times Bitcoin has failed to reach an all-time high after a 40 to 50% correction? 0. 9 out of 9 times Bitcoin has recovered. And the average recovery time for a correction of this specific depth is between 9 and 14 months. This is not the 2022 bear market, where we drew down 77% over systemic bankruptcies. This is a standard mid-cycle macroeconomic shakeout. Something else that you may also want to consider is how liquidity is likely to shift in the coming months. Over the past year, most people have focused exclusively on broad measures of money supply as a sign that Bitcoin could be about to shift. They praised the almighty M2 indicator and yearned for quantitative easing. However, according to a recent report from KeyRock, it's not the Fed, it's not QE, it's all the Treasury. Since 2021, the liquidity source with the strongest leading relationship to Bitcoin has been Treasury bill issuance. Treasury QE or T-bill issuance shows an 80% positive correlation leading Bitcoin. When T-bill issuance starts to pick up, we tend to see Bitcoin follow months later. It has been fading into early 2026, and Bitcoin weakness lines up with this. But consider this. A $3 to $4 trillion annual refinancing wave is building through 2029, and the path of least resistance is more short-term issuance. So that's liquidity. But finally, let's not forget about the inflation rate of Bitcoin versus gold. Bitcoin's block reward is now just 3.125 BTC per block. The daily issuance is a mere 450 Bitcoin, and that makes the inflation rate about 1%, making it mathematically more scarce than gold, which inflates at about 1.5 to 2% a year. Right now, the market is completely ignoring this potential supply shock, and that's just because demand has temporarily dried up due to the macro concerns I mentioned earlier. But when the panic subsides, as it always does, that supply deficit is going to have an impact. And even with the recent outflows, Bitcoin ETFs still hold roughly $85 billion in assets. That is sticky, long-term capital sitting in retirement accounts and pension funds. They aren't panic selling because of a 150-day tariff. The outflows we are seeing right now are largely hedge funds unwinding their cash and carry basis trades, not long-term believers abandoning the asset.
What's the verdict?
Well, the Trump premium that pumped the markets in late 2024 has completely evaporated. Bitcoin is currently failing its test as a short-term safe haven. When the VIX spikes and the Nasdaq bleeds, Bitcoin is going to bleed with it. And this is the price of institutional adoption. But if these global tariffs spark a new wave of sticky inflation, the fundamental thesis for holding a decentralized, capped supply asset has never been stronger. The weak hands are being shaken out by Wall Street algorithms and forced liquidations, leaving the true believers to scoop up the pieces at a massive discount. The question isn't whether Bitcoin recovers. History says it does, every single time, even from a 40 to 50% drawdown. The question is, are you the one still holding when it does? But what do you folks think? Is Bitcoin's safe haven narrative officially dead? Or is this just the start of a temporary macroeconomic shakeout? Let me know in the comments down below. And if you want to understand how the Fed might actually react to these tariffs and what it means for interest rates, check out our macro deep dive right over here. Okay, that's all from me for now. Thank you guys very much for watching, and I'll see you again soon. Nick, over and out.